The following interview was recorded for PrivateEquity.com radio and the Certified Private Equity Professional CPEP Certificate Program. For more great interviews and other private equity resources, visit PrivateEquity.com.
Today, our guest is Barbara Piette. She is the managing principal of Knightsbridge Advisers, a Boston-based, highly specialized venture capital fund of funds. We were pleased to have Barbara join us for this interview. Welcome.
Thank you so much, Theo.
Yeah, we appreciate you coming. So just to start off, I wonder if you could please briefly describe your position now. What do you do in private equity and venture capital?
Sure. So I co-manage a premier venture capital fund of funds with about $1.2 billion under management. We direct our investments to top-performing venture capital franchises, and we've achieved outstanding access to key VCs. Our underlying portfolio companies are across various subsectors of IT, energy tech, and life sciences, but principally IT. Mm-hmm. We also, as a firm, provide a high level of service to our investors, and they include endowments, foundations, corporate and public pension funds, and family offices.
Okay. Well, great. That's a nice little overview. So I wondered how you ended up in this position. I know you have some prior experience in venture capital, obviously many years in there, but I was wondering what your professional experience was prior to entering private equity and venture capital. Did you work in investment banking or a related field like that?
Sure. So prior to Knightsbridge, which is a venture capital fund of funds, I was a GP in a venture firm for most of my career, first with Charles River Ventures, and later I co-founded really Schroeder Ventures Life Sciences. So, I understand venture capitalists in whom we invest because I've been in the trenches and helping to build companies just as they do. Sure.
Okay. Well, that seems like a pretty relevant experience for you, and I'm sure that was great in building Knightsbridge. So, I wondered, how does your fund identify managers and select them from the thousands that you could be investing in? I know that's a difficulty. We were just speaking with a fund of fund pretty recently last week, and that's the big value add for a lot of their investors, and for what separates them is just how their ability to identify and track those managers. So I was wondering if you could share a little bit on how you identify managers and select them.
Yeah, absolutely. And this is the $64,000 question. So I may be long-winded, and I apologize. But
no
I guess we think through it according to certain principles, basically. So first, there's a huge dispersion from the mean among venture managers. Mm-hmm. The top quartile of the industry, one could even argue the top decile of the industry, far outperforms all the rest.
Sure.
So investing in this business is all about manager selection. It's the most important element. And, geographical or sector diversification is not meaningful. It's all about manager selection. Mm-hmm. And we focus on the true company builders. In other words, those VCs who have the necessary skill sets to truly partner with and add value to the entrepreneur. Every VC will say he or she adds value, right? So it's up to us to figure out who really does. and they add value in a variety of ways. They may have really deep domain expertise in a given industry sector, and in turn have deep networks to tap into for their entrepreneurs. They may have been successful company founders themselves, and understand on a very visceral and practical level the challenges in building an early-stage company. They help their companies with go-to-market strategy, sometimes even with product development, certainly with business development and sales, with board composition, and then at the latter stage of the whole cycle, of course, with exit strategies. So the second principle that we operate by after manager selection is the fact that there's persistence of returns in venture capital. So in other words, there's a high correlation between prior performance and future performance. And, as you, I'm sure know, this has been well documented by some of the industry academics like Josh Lerner of HBS and Antoinette Shore of MIT. And certainly it's been our experience in the field. The best VCs simply have superior deal flow, better selection criteria, and the experience that I just talked about that's most helpful to the entrepreneurs. The third element, and this is despite the truism of persistence, is that some franchises just may stop capitalizing on their historic excellence. And it's our job to recognize signs that the GPs are either not working hard enough or failing to select and mentor their next generation of, partners and of entrepreneurs. And so we look deeply into current portfolio to find the evidence that they're still attracting the best of breed entrepreneurs.
Sure.
And then lastly, it brings us to the important question is sort of, so what about new venture franchises? So because I've talked about persistence of returns and experience in company building and all that, but what about new franchises?
That's what I was going to ask, actually. So that's a great lead-in.
Sorry, I preempted you.
No, right.
But it is a big part of what we do. We constantly have to be looking at the new teams and to be identifying up-and-coming managers that have the DNA to be top-performing franchises. Having said that, our strong bias is to select those Roman numeral 1 or 2 funds that are populated by GPs that have prior track record elsewhere, and that have proven that they have the DNA to, be money makers and produce realized returns.
Sure.
Certainly, the industry is also populated by some fabulous former operating people. Our bias is we love teams with proven money makers on the investing side, and proven successful company builders or entrepreneurs. And they each have a lot to add to a team.
Okay. Well, great. Yeah, that was a great overview of that. I wondered, just to touch on one of those points. So, for a new manager, a new venture capital fund, would you find that more? Do you identify more via referral, or is it more actively monitoring a select number of venture capital firms? Like if you see someone starting up and the previous venture capital firm or the previous startup they were at, are you tracking them that way, or is it more common that you see someone say, "Oh, you should keep an eye on this person or this venture capital firm," or you hear about some impressive investments that they knocked out of the park? Or how does that usually work to track the new emerging managers?
Right. So you really hit on the two important things that we do. So, we really get to know as many or all of the GPs in any given franchise that we're invested in, because you always want to keep your eye on a terrific next generation person who might be spinning out for some reason. We also, when we're meeting with RVCs, are always asking them, what's new? Do you see any new firms? Is there anybody that you really respect? Do you know anybody that's unhappy where they are? So we're both reactive listeners to what's going on and very proactive speakers.
Sure. I think that makes a lot of sense, and that's what I've seen from a lot of successful fund of funds is that they're really taking it from any information they can get in any way, and they're really trusting their LPs to advise them as well. So that's pretty consistent with what I've heard. Okay, well, that's great to hear all that. I'm sure the audience will love to hear how you've selected your current managers and how you look at future ones. So that's great. So my next question is, how does a fund-to-fund investor manage a portfolio of managers? So you have all those managers that you're evaluating and currently investing in on behalf of clients. Are there key metrics that most fund-to-funds rely on to compare managers, manage risk, and balance a portfolio?
So our value add, our mission, if you will, is to offer our LPs access to the top access restricted venture capital funds. So we're not trying to balance risk in the same way as, a mutual fund manager might, or in fact as our investors need to.
Sure.
We're offering a specialized strategy of access to these access restricted funds. And risk is an interesting dynamic in venture because, in fact, if you look at top quartile venture returns over the past 30 years, you'll see that the top quartile has never, even in venture's darkest hours, lost LPs' capitals in a given vintage year, which is an important point, and it's a little counterintuitive because the best VCs tend to be early-stage investors, tend to be going for the, hitting the ball out of the park kind of strategies, and yet they've consistently been the least likely to lose LP capital.
Oh, really?
I guess the other point that I'd like to make in terms of, portfolio construction and management is that within our portfolio, 80% of our LP's capital is deployed with these top established proven franchises. 20% is deployed with what we call the quote-unquote challengers, which we would define as those franchises that have excellent private portfolios in our estimation and populated by GPs with prior track records, but where the franchise itself may not yet have proven realized returns.
Okay.
And those may be, Roman numeral 1, 2, or even 3 funds, before you actually prove realized returns. And then also within our portfolio, 80% of our LP's capital is invested, initially in early stage companies. And then 20% is in growth equity.
Okay.
Our portfolio provides manager diversification, which is important. Typically, it needs a pretty concentrated strategy on a relative basis. So we'll invest typically in 13 to 15 franchises and a total of perhaps 18 to 20 venture teams. And the distinction I'm making there is, the franchise may be the brand name fund, but there may be a family fund. So there may be, a China fund by the same name or a growth equity fund by the same name. So we consider the total as the franchise.
Okay,
and
makes sense.
The other, area of diversification is industry diversification. And again, where our underlying portfolio is across multiple subsectors in IT, life sciences, and energy tech. But again, it's really predominantly IT. So the kind of diversification that we would provide is really across multiple managers, although not too broadly, because you want a big enough piece of those billion-dollar companies. And the other area of diversification is vintage year diversification, which is really important in this industry, because it is a cyclical industry, as you very well know. And so we try to provide diversification across at least 3 vintage years in any one of our composite funds.
Okay. Oh, that's really interesting to hear how you break that up. One question off that is, what led you to focus specifically on IT? Is it more the background of your team, or is it you particularly see the opportunity there? I know that's sort of a well-tread ground in venture capital. It's a large area of focus where it needs that early stage investing, so it makes sense from that standpoint. But I was wondering if there's any other factors that led you to focus more on IT and life sciences.
No, it goes back to our overarching framework, which is manager selection. So for us, it's all about find the best VCs on the planet, and they will decide what is best to invest in.
Sure.
And historically, that has been mostly IT. It's just been harder to make money in both life sciences and energy tech, although we have great examples of money makers in both of those categories, and we have winning underlying portfolio companies certainly in each of those categories. But most of the money in venture has been made in IT over time.
Sure. Okay, that makes sense. And I wanted to ask if there's something that fund managers sometimes do that instantly disqualifies them for a potential investment from your fund to fund. Are there mistakes they make? I know that a lot of funds have expressed some frustration with not being able to draw allocations from fund to funds, but I think that speaks more to the process by which they're evaluated, and sometimes it makes sense, and other times it just doesn't. So I was wondering if you could speak a little on that.
Sure. I mean, to be glib, failure to make money for their LPs is the biggest disqualifier.
Sure.
But we have certainly re-upped with firms that have had, a bad fund. So it's not that there's this absolute black and white. If you underperform ever, you're out. It's more about, I mean, we ask ourselves, is this venture franchise equipped with the people, the expertise, the skills to attract, select, and help the, billion-dollar companies of the next going forward 4 or 5 years? I mean, that's what we're looking for. So, any consistent failure to outperform, any failure to stay true to a stated strategy, failure to appropriately mentor the next generation, blatant strategy drift, all those would be certainly disqualifiers. Sure. The other thing that we look at and care about a lot is pace and amount of capital raised. So there's no magic number in terms of fund size, and it partly depends on, how many partners, what's the strategy, how do they work as a team, how is the decision-making set up. So it's a very complex metric that we think about when we think about fund size. But, if you look at the disastrous performance in the 99-2000 timeframe, for example, and you just get a lot of the problems came down to raising too much capital, investing it way too rapidly without the usual historic discipline, and perhaps hubris.
Yeah, that seemed to be a consistent theme in that time period.
Yeah.
Okay. Yeah, I think I definitely agree with all those points you just raised. And I was sort of following what we were speaking about before with the emerging managers. And so if someone felt like they fell under that criteria, that they, deserved at least a look from a firm like yours, how do you think is the appropriate way to approach and update a firm like yours for a fund manager who's seeking capital from your looking for capital from a venture capital fund to fund? Is there a way that they can do that without, inundating you and your team with requests and performance updates and that sort of thing? I know we receive that on our end, and a lot of the family offices we've worked with have complained about, receiving constant updates on performance and things like that. So I was wondering if there's an appropriate way, or if you know the managers you want to track and you just kind of follow it that way.
Yeah, it's a good question, and it's a little bit the Groucho Marx or Woody Allen line of, if the club wants you to join too badly, you probably don't want to join it. So people that are, desperately fund seeking are probably not people who are going to invest anyway. But I think, when you think about a new fund or a fund that is not part of our universe yet, I mean, we want to get to know people over time, and we want to get to know their track record over time. So a certain amount of patience is necessary, and it's not because we, aren't paying attention. It's because relationship matters and track record over time really matters to us. We prefer firms that are very transparent, that are clear about their track records, that are willing to provide, deal attribution per partner, that can talk cogently about the value add that they provide to the companies in which they invest.
Sure.
Softer issues like your economics, governance are factors which contribute heavily to the long-term success of a franchise, so that's something else we care about. And in terms of, an absolute new fund, certainly a referral from somebody whom we deeply respect matters a lot. So in other words, if one of my, most brilliant money-making GPs says, you should go look at XYZ new firm, I think they're terrific, and I know one of the partners there really well, and I've co-invested with them, that is
that goes a long
entree.
way.
Yeah.
Okay. Yeah, I think that makes complete sense. Seems like a lot of this is built on personal relationships, being able to, know the other person on the other side of the table rather than, just receiving some materials in the mail or receiving an email from somebody. It takes time and takes patience. So I think that's a good lesson.
Yeah, absolutely. It's a long-term relationship. These are 10-year partnerships. And so this is a long-term commitment from the investor's standpoint, and also from the GP standpoint. So you
Sure.
really do need a certain amount of chemistry there as well.
Well, and I'm sure, I mean, you owe it to your LPs to be able to say, we've known this person over time. It isn't just a quick opportunity. It's something that we believe in long term. So I think that makes sense.
Yeah.
Okay. And we spoke a little bit about the previous quote unquote tech bubble. And I was wondering what do you say to people who believe we're entering another tech bubble with billion-dollar valuations for young companies like Instagram? You see it every day in the news. You see, one side taking the position that these valuations are out of control, and the other one saying, it's accurate. It's not like before when you had a lot of capital flooding in. So I was just wondering if you could provide your quick take on that.
Yeah, I mean, it's something that we worry about all the time, and certainly our GPs worry about all the time.
Sure.
So, and we've certainly seen subsector bubbles. I mean, it would be hard to argue that social media, for example, had not become wildly overinflated a couple of years ago. Now, some of our VCs would certainly say that certain sectors within enterprise is overinflated. But it's sort of on a step back and look at the bigger picture level. When you look at the venture-backed companies that have gone public over the last several years, what you see are mostly, companies that have strong growth, reasonably repeatable earnings, solid companies that, for the most part, have rewarded public investors, and certainly not the companies that you were seeing in the real bubble of 2000 that were going public without even a clue how they were going to monetize.
Sure.
You're just not seeing that. Do we see some, apparently crazy prices? Yes. Do we see reasonable, disciplined, intelligent VCs with great track records paying some huge prices right now? Yes. Does that make it a bubble right now? We would say not yet. Not yet.
Okay. Yeah, no, that's good to hear your take, and I'm sure it's well informed by your GPs as well. So that's interesting. And I was wondering along those lines, how does a venture capitalist? You can speak from the GPs that you invest in or their take, but how does a venture capitalist invest confidently when you see company valuations fluctuate? Is it just sticking to the fundamentals, believing that they're going to build a strong company? Is it along those lines, or if you could shed some light there?
Yeah, I mean, our VCs will talk about pricing a lot, and they spend a lot of time thinking about valuation. And it's for them, it's particularly when a subsector becomes overheated, the VCs really have to weigh the value of maintaining price discipline versus missing out on the next multi-billion-dollar exit. And it's one of the reasons that partnerships are a great way to be investing, because it's easy sometimes for an individual GP to get really excited about a certain charismatic management team or a market that seems like it's going to break and be huge, or a truly disruptive technology. That's why you have partners to say, hey, wait a minute, what about how this company is going to monetize? What about the competitive factors, et cetera? So I think that there's certainly a lot of checks and balances in any venture firm in terms of making a new investment. And ultimately it's going to come down to perceived attractiveness of the subsector, the perceived skill and experience of the founder and management team, and ultimately the value of the intellectual property as it exists in its marketplace and how disruptive is that marketplace. So I gave you a total roundabout, perhaps non-answer, but
no, I appreciated it.
Yeah, I mean it's certainly something that they care and think about, and that's what they talk about at partners meetings.
Okay. Yeah, no, I think that answered the question pretty well, actually. I think the emphasis on partnerships, I think that's an important thing to note. So, yeah, thank you for that. I know that Knightsbridge is an early-stage investor, predominantly, I believe. Why do you see early stage investing as superior to investing in more mature companies or a later stage focus? Is it the ability to get in early and be able to form those partnerships with the entrepreneurs and be able to get in there before things heat up too much?
Yeah, I mean that's absolutely part of it. Also the ability to influence the company in a meaningful way. If you look at early stage venture capital over long periods of time, so take between 1986 and 2010, average upper quartile returns for all stages of venture was 26.1%, and for early stage it was 30.6%. I mean that's a big dispersion. And then to your question, why? We believe that this outperformance exists, and we believe it'll persist because there'll always be less than perfect information about the very earliest stage companies, right? And therefore a disproportionate advantage for the stage VCs. Also, if you believe that the best VCs truly add value, they tend to do that at the earliest stages of a company's life, helping with strategy, refining that last bit of product development, bringing in that great CEO to supplement a super founding team, etc. So for all those reasons, we're very bullish on early stage.
Yeah, so it seems like the inefficiency in the information creates a pretty big opportunity for venture capital in the early stages. No, I think that's a good summary of the opportunity. So sort of continuing on that thread, in what ways is fund-to-fund investing in venture capital funds different from fund-to-fund investing in large-cap buyout firms? We've spoken to a lot of private equity fund-to-funds that take positions in the larger, well-known firms, and obviously there's a distinction between those two. And I was just wondering if you could flesh that out a little bit.
Sure. So I guess first and foremost, manager selection is very different. So venture is a nuanced industry. It's a granular industry. It's highly dependent on individual practitioners. While the franchise brand name matters, at the end of the day, from the entrepreneur's point of view, it's the individual GP that's most important. Sure. In buyout funds, it's easier to bet on a brand because it's easier for a buyout fund to create, a machine, a replicable process within a firm. I guess second, the value add is very different between these firms. So what you're judging them on, in addition to ultimate exits and outcome, is the value add. So the best VCs are helping to build companies. They're directly influencing, product development strategy, management team, blah, 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 all the stuff we just talked about. The best buyout firms influence management, maybe not. Often they do. They help procure bank debt. They get involved in M&A activity. They do the financial engineering stuff. So you're judging the firm very differently.
Sure.
Third, the source of the ultimate value creation is so fundamentally different. So buyout fund of funds ultimately make their money based on operations, execution, financial engineering, where a venture capital fund of funds, we ultimately make our money based on innovation.
Sure.
Which I think is a key reason for an LP to have both buyout and venture in their portfolio, because it's another source of diversification, this ultimate value creation reality.
Absolutely.
And then the last point I guess I would make about the differences between buyout and venture is the fact that fund of funds investing in venture is particularly difficult because of this access restricted. The best VCs, particularly the best early stage VCs, are simply highly access restricted. These funds raise relatively small amounts of capital, certainly relative to buyout funds. We're talking about funds that are turn of 50 million, maybe 500 million in size, versus multi-billion-dollar buyout funds.
Yeah, so quite the distinction.
Yeah, exactly. And so that means that an LP will have a much easier time getting into a buyout fund directly given the large amount of capital raised. But in early stage VCs, it's near impossible for a new LP to gain access to these established top-tier players. It's near impossible for a new LP actually often to gain access even to the Roman numeral I funds that are populated by the superstars, right? So as such, firms like Knightsbridge, which have been in the business of building these relationships with top VCs for 3 decades, are able to provide that highly sought-after access.
Okay. Well, I think you sort of led into my next question and maybe even answered it. I was going to ask you what makes your fund-to-fund offering unique from other competitors in the marketplace, but it seems like a lot of your competitive advantage is access to those top quartile venture capital funds that may not otherwise be available to investors in the same way. Yeah. So would you say that's pretty much the answer to that question?
I would say that that's the key element. There are probably a couple of other things. And again, if you look back at some, historic Josh Lerner analysis from the middle of the last decade, he did a lot of analysis on what are some of the factors that make a venture program great. And he looked at Yale specifically and looked at Yale's re-up decisions and noted that over time, if Yale turned a franchise down, ultimately that firm indeed was an underperformer. And the converse was also true. And we agree with that. And we feel like the re-up decision-making process is as important as the initial investment. We think a lot of our competitors are probably softer on that issue. It's just, you know these guys, you've been investing with them a long time. It's a lot easier to just re-up. We try to be super disciplined about that, and we've made some tough decisions over time.
Yeah, I imagine that's a tough conversation with somebody you've built that relationship with and that you've been investing with for, could be a few years now.
It's awful. It's really, really awful, but we feel like, we owe it to our LPs. The other thing I think that differentiates us from at least a lot of our competitors is we provide a super high level of service, analysis, and transparency for our investors. I think that there are certainly some in the industry. We've heard from our investors that, kind of show a black box to their LPs. I mean, we obviously don't give away any information that we're not supposed to give away from our VC's point of view, but our process is all utterly transparent to our LPs.
Okay.
And I guess the other thing that sets us apart and I think makes all of the above a little bit easier for us is that our team's relatively unique in that 3 of our 4 investment managing principals have direct investing experience ourselves. So we've either been VCs or direct investors into companies. So we totally understand the challenges that our VCs and their entrepreneurs face. And that leads to, I think, more meaningful conversations, probably better due diligence. And certainly, I think, garners their respect because they know that we, quote unquote, get it.
Yeah, you've been on the other side of that table.
Yeah.
Okay. Yeah, that was really interesting. Sounds like Knightsbridge is doing some interesting things and has some pretty detailed processes for evaluating their managers. So that's great to hear. I guess my final question would be, what do you think is the number one misconception of venture capital fund-to-funds? Is there one that particularly sticks out to you?
I am so glad you asked that question. I think the number one misconception of a venture capital fund-to-funds is that we're all alike. And we're so not alike. Some fund of funds invest very broadly, feeling that their mission is to provide quote unquote waterfront access across, the multiple VC firms. And frankly, our belief is that they end up therefore with vastly more capital in the second tier, easier to access funds, and therefore are more likely to end up with returns approaching the median. So I think that's the number one misconception is that all fund of funds are created equal. Could I possibly ask you to accept a second misconception?
Absolutely. I'll allow.
Thank you. I think the other misconception, and I've seen this over and over again, is that a lot of LPs believe that it's easier to develop a venture program than it is. And the reason for that, again, and I don't mean to perseverate about this access issue, but, it's really difficult to gain access. In many firms, it's impossible for a new LP to gain access. And I think some LPs building a new or wanting to build a new program just really don't get that completely. It takes years to build relationships with these GPs. Due diligence can be a very difficult problem if you don't already know people in the industry. And then the kind of due diligence you do is, it's back to what I said earlier about it's very nuanced, it's very granular. You can take a very good venture firm, and if even just one money-making GP leaves, it can change everything. And unless you've got a great staff and you're out there and you know the industry really well, it's very hard to keep track of all that. And many LPs simply don't have the staff or the time or the budget to build and maintain an excellent venture program.
Oh, that makes a lot of sense. I mean, it's not something you can just jump into.
Exactly.
Okay, great. Well, those are all my questions. Is there anything else you wanted to cover, or is did I run through everything?
I think you just covered absolutely everything. I appreciate your questions so much.
I appreciate your answers. I think this was a great interview, and I was really happy with it. I can just close up with today our guest was Barbara Piette from Knightsbridge Advisers, a Boston-based, highly specialized venture capital fund of funds, and we're very happy to have had her on Private Equity Radio. And I just want to thank you so much for your time.
Thank you so much, Ben.
Thank you for listening to PrivateEquity.com radio. If you would like more interviews, visit PrivateEquity.com. At PrivateEquity.com, we offer private equity data, webinars, training programs, networking events, and other valuable resources for private equity professionals.